2008, the iPhone came out. If everyone looked at each other in 2008 and said, this is what the world would look like in 2024, we'd probably laugh at them. Right. So I think you fast forward 15 years from now, the world's going to look like a very different place than it does today. And that is, there's an immense amount of investment opportunity there.
So I want to introduce our speaker, and I thank you for being on, Tim, and for everybody that's going to watch the recording, I thank you for watching the recording. Our speaker is Aaron Dillion. As a person that's going to talk about an area of the market, pre-IPO investing, and I want to level set with even explaining what that is in a minute. You really have to have a good, varied background and connections in the industry to unlock what he's created. And I just want to run through some of the things he's done. He's been a managing director at SoFi, and he's been at the London Stock Exchange. He's been at Crane Shares, which he actually helped, found and create. So if you ever buy a Crane Share ETF, you can thank Aaron. He's been at TD Ameritrade as a director, head of mutual fund and ETFs, and he's been at Morgan Stanley Wealth Management. So with all of that, he's met a lot of interesting people, and I think that's part of what's helped him unlock some of these opportunities. He's also, from time to time on with the people that you see on CNBC, like some of these guys, Josh Brown. So he's really kind of sought out for his knowledge in this arena. And I think he's created something really interesting. And I'm really grateful that, he's even given us the opportunity to participate in it this last year. Because I think there's these opportunities are going to be extremely fruitful. And I want to talk about some of the nuances in terms of why. And I do want to give one last little plug. We were both our senior year in high school on the Fab 50 for volleyball, and I was rated slightly above him.
I don't know if you're above buddy.
I had to say it. I had to say it. I wasn't going to say it, but I had to say it. So
No,
there
I
you
like
go.
that. That's good. That's good.
Shameless volleyball.
I think
plug.
you edged me. It was like what, 2 spots, 3 spots? It was
two
good.
Two
it
or
was
3
material.
spots. Yeah.
Yeah, it was material.
Yeah, man. My son, I showed my son the thing, and he was like, "You weren't on the Fab 50," and I'm like, "Oh my gosh, it take me back 20 years."
Right.
More than that now, 25.
The life before you.
I know.
Yeah, that's great. That's great.
So let me I want to level set, because I know Aaron has some kind of formed remarks already, kind of like set remarks. But before that, I want to give some context for what we're even talking about, because I think it will help. It will help to really appreciate what he's created. So can we just start, Aaron? Tell us, like, when someone says pre-IPO, right?
Yeah.
Secondary markets, like, what does that mean in comparison to public markets like Apple?
Yeah, sure. Good question. So look, just like there's every company has stock in it, right? So if you started a business, you have perhaps business partners or investors, right? They own stock in your company. And it's not any different. That stock, when it's a public company, that stock just trades on the New York Stock Exchange or NASDAQ Stock Exchange. It's very simple and easy to buy and transact, et cetera. You can still do that in the private markets. And that's really effectively where I focus. Most times people think about buying stock directly from the company, right? So that's when, if there's like an IPO, people are familiar with IPOs, you're buying public market investors are buying stock directly from the company. If they do a second, an additional offering, and the public company does an additional offering, they're selling more stock to investors in the public markets, right? So that happens in the private markets too. Most people think that's the only way to buy private company stock, but you can also buy private company stock from an existing shareholder in a private company, and that's called a secondary market transaction. Most people are familiar with secondary market transaction in public stocks. When you buy a public stock like Apple or Amazon through, Schwab or Fidelity or TD Ameritrade or with your financial advisor, you're not buying it directly from the company. You're buying it from another shareholder, an existing shareholder, right, that wants to sell. So effectively, there's 2 ways to buy stock: primary markets or secondary markets, and that's the same for both public market stocks and private market stocks. In public markets, it's super simple and easy. There's plenty of places to go and do that. And private markets, it's much more difficult to do that. So it provides opportunities for folks like myself to step in and help investors.
Right. So that IPO stands for initial public offering. So it's when it transitions from being a little more difficult, like Aaron's talking about, to now you can just go and open up Robinhood or whatever and buy it sell it same day, we do whatever you want. It's totally much more accessible and easy to trade, right?
That's
So
right.
in that pre-IPO world, you've talked about how it's becoming more attractive, right? That's where
Yes.
some of these companies are that are going to have, I think, a little bit more growth. Can you talk a little bit as to why is that the case now versus say
Sure.
2005?
Yeah, so there was a fellow named David Swenson. He was the chief investment officer at Yale's endowment fund, right? And this was maybe 20 years ago, right? He decided that he was going to have a large allocation to private investments. So his performance was off the charts, very good. And it was primarily due to his private markets allocation in the endowment's portfolio. So that started to resonate, and more other endowments, foundations, pension funds started to adopt that. It's now kind of moving into the wealth management space, right, to a large extent, and more capital, so more allocation, more capital is going into the private market. So to your point, Eric, and Tim mentioned this earlier, these companies are staying private for longer. There's more capital and access for them to be able to grow their businesses and do the things that they need to do in the private markets without going public. I mean, typically, a company, a CEO, like if we were an executive team here on the call, right, running a technology company, and we were like, man, we really want to expand into Europe, or we want to open up this new product offering, or perhaps we're just getting so big we need a bigger team, like we need more data centers, we need more developers, like we got to get capital to take advantage of this opportunity. The only way to typically do that was to go public, to access that much capital that you would need to be able to drive and facilitate the growth of your company. Also, if your employees or investors would be like, look, Eric, you're the CEO of this tech company. It's been 10 years. It's enough already. Like, we're ready to go public so we can sell our stock and like book the gain. You don't have to do any of those things now. So in the private markets, there's so much capital you can continue to raise, right? And then also there's a secondary market now, like we described earlier, where employees can get liquidity. So there's still good reasons for companies to go public, but that allows companies to stay private much, much longer than they had historically, right? Maybe the last thing I would say is like a lot of folks have heard the term unicorn, right? So a unicorn for a company was when they hit $1 billion valuation, and that was the sweet spot. So you hit $1 billion valuation in the private markets, you went public. That was it. And then you went public and you became a small cap stock in the Russell 2000. And then as you grew, you went into mid cap and large cap, et cetera. Now companies are not going public when they hit $1 billion. There's private companies that have $300 billion valuations, and they're still private and they're still growing very fast, right? So when those companies go public, they're literally going to go right into the S&P,
Mm-hmm.
right? So an Amazon that went public when it hit $1 billion, right? And now it's a massive multi-trillion-dollar business. You're gonna have like a SpaceX or an OpenAI, right? Or a ByteDance, which is TikTok, right? They're private and they're north of $100 billion valuation each, right? And when they go public, they're gonna slide right into the S&P 500.
Right. So what you're saying is if you want to get into that growth from like a billion and up in these private companies, and I think it's interesting to say which companies are taking advantage of this. And this is kind of where I think your niche starts to come in, these tech companies,
Mm-hmm.
right?
Yeah,
And
that's right.
you talked about ByteDance, SpaceX, these companies. Why wouldn't they, like, staying private? What advantage does it give them? I know they have liquidity, so like they don't need to, but are
Yep.
there any other advantages to staying private before we get into these companies? Because I think it'll help people understand why investing in, in this stage gives them the opportunity to make a lot of money.
Yeah, so I think, well, one, yeah, when you're a public company, the SEC requires you to publish earnings every quarter, right? So
Mhm.
there, I think with that, and a lot of people are familiar with that. So with that becomes this heightened scrutiny around what they're doing, the performance driving. So there becomes this like immediacism with CEOs and executive teams to like deliver results on a quarterly basis. And 3 months is not a lot of time, right, to really do anything, right? Especially if you're running a big business. So if you're private, you don't have to worry about that. If you want to make an investment and it's going to take time for that thing to pay off, maybe 3, 5 years, it's okay. Like the only people you have to report back to are your investors, right? So if they're on board and they believe in what you're doing, then you're okay, and you got the time and the patience to be able to have those things play out. So I think that's probably the primary reason, Eric, right, is
Mhm.
for a company to stay private, is they can have more of a long-term vision, and kind of invest into the business for longer term results as opposed to more short term results.
Right. So you're talking the ability to capture really, and it's not at $1 billion plus, but as these companies stay longer and longer, that growth, and the companies that you're talking about all have extremely high growth rates. I'd love for you to talk. I think this would be a good time to kind of pivot to really kind of maybe some of the prepared remarks on, say, like a
Okay.
SpaceX, and why staying private is so impactful to them, and really
Right.
kind of their valuation, where you see it going while they're still even private. And then maybe
Yeah.
slide from there. I'll transition then to the index, and then a diversified way of doing it. But let's start on SpaceX,
Yep.
because I think it's a name everyone knows, and you can talk about how, staying private and investing in them now makes sense.
Yeah. So maybe one thought just before I launch into SpaceX. So, this is my opinion, right? I think if you want to be a diversified US equity investor, right? 10, 15, 20 years ago, you could buy an index fund, a US equity fund, mutual fund, and you had exposure. With these companies staying private for longer, and also technology companies being such a main driver. I mean, they have a Mag 7. There's a name for it now for public stocks, right? Mag 7, the main driver of growth and technology advancing is going to be in the private markets. So all of this growth happens while they're private, and then they go public, and they're already in like the top 150 of the S&P 500. So if you want to take advantage of that and have similar type return profile as you had historically, I think you have to have exposure to the private markets, right? And to be able to take advantage of that. So, okay, let me get into SpaceX. So, hey, can I share my screen real quick, guys? If not,
Yes,
that's
I
okay.
can.
But okay. All right, here we go. Perfect. Okay, can everyone see that all right?
Yes, sir.
All right, perfect. Let me do this. So this is my SpaceX highlight reel. Okay. Okay, so SpaceX is a space payload and satellite space payload delivery, excuse me, and satellite internet company. They're the first government or private company to develop a rocket that can deliver a payload to space and land back on Earth. So the reusable rocket allows SpaceX to spend less per launch, and it also drives down cost per launch, right? It's a massive moat for competitors trying to enter the business, and we believe that this reusable rocket has given SpaceX effectively a monopoly on space, right? So, for example, the company had 96 successful launches in 2023. They had no errors, right? The next closest competitor was 67 launches. That's the Chinese government. So SpaceX is outpacing the Chinese government by a margin, right? Uh, in 2024, they're set to launch 148 rockets through August, right? They're at 84 launches, so they're on track. And again, they haven't had any issues. So they got a massive head start on competitors with a gap so big that I don't think, hold on a second, there we go. Sorry about that. With a gap so big, I don't think they're going to be able to have anyone ever catch up, right? So they're also designing and testing a new rocket called Starship, which you're going to see here in a second. The Starship's completed 4 test flights so far. The last test flight, they brought the rocket back down to Earth, and the spaceship, right, was quote unquote landed in the Indian Ocean. So all of this progress that they've had with Starship is just happened in 1 year's time. When SpaceX first rocket, the Falcon 1, launched, they had 3 attempts before they successfully reached orbit. SpaceX reached orbit on the second attempt with the new rocket, and it took them 2.5 years, kind of start to finish, right, to get a successful launch out there. So Starship's 5th launch is going to happen in November, right? And we're expecting them to kind of land the booster rocket. They're going to attempt to do that. So that's going to be quite something. They have literally arms that come out and catch the rocket as it's landing. It's going to be quite a sight. So it's much more efficient too. The Starship rocket is efficient. It's got 5.5 times the payload of the Rocket 9. So this means more revenue per launch. And also the cost for the Starship per launch, once it hits scales, is estimated to be $2 million per launch versus Falcon 9, which is $15 million launch. So SpaceX makes $62 million right now on the Falcon 9 launch. That's the current rocket that goes up. So this increased payload capacity is going to generate more revenue at less expense. So it's going to be a massive pop to earnings, right? They also have, this is Starship here that you're watching as well. There's also They have a satellite internet business. So the satellite internet business is called Starlink. The company's sent over 6,000 Starlink satellites to space to date, with a goal of having 42,000 in orbit. Right? They charge $110 per month for the satellite internet service. I don't know if you saw that United just announced that they're going to be putting Starlink satellite or Starlink internet service on all of their planes, right, globally. That's a big win for the company. And once they get all these satellites in orbit, they're going to be able to service 2.5 billion people in the that don't have access to the internet today. So just to drive that home, that's not, they don't have access to high speed internet. That's zero internet. 2.5 billion people. That's a third of the world's population. That SpaceX is effectively going to have a monopoly on delivering the internet to those people, right? So we estimate Starlink's got about 3.5 million subscribers as of August. That's up from 1.3 million in December of 2023, just 8 months ago. So that's 162,000 new subscribers per month on average. Right. So once Starship gets launched, just to kind of hit on that, once Starship actually goes to market and into production, they're going to move up to 400 satellites per launch. They do 60 right now on the current rocket. So they're going to make massive progress towards that, to that area. Last thought just on financials. So SpaceX has got about a $220 billion market cap. If it was publicly traded, it would be number 39 on the S&P 500. Right. So that kind of drives home the point of what we were talking about earlier. Right, Eric? The business is forecasted to do $15 billion in revenue in 2024. That's a 67% increase from 2023. Most of that incremental revenue is coming from Starlink, which is really starting to scale and grow. So the three reasons why we like entry into SpaceX right now is Starlink. So one, we think that business is going to grow to a $30 billion annual revenue business once it hits scale. That's a huge business, right? It's effectively a couple $1 billion today, right? Also, the new rocket Starship's going to open up a lot of new revenue, drop a lot of earnings to the bottom line. It's also going to open up new channels for the company as well. And then last is new businesses that are coming. So this kind of technology they have, and it's more or less a monopoly, right? I think it's going to open up opportunities in space manufacturing, space mining, and space travel. Right. So space travel is not, us going to Mars. It's from New York to Beijing in 30 minutes instead of 13 hours. Right. Space manufacturing, believe it or not, there's some things that are less expensive to build in space at zero gravity, manufacture in space, than to manufacture them here on Earth. And then lastly, space mining. There's some asteroids that are close to Earth's orbit, where scientists estimate, for example, that there's more gold on this one asteroid than there is gold on the entire planet Earth. So the access to raw materials through these through asteroids is going to be something that we'll be talking about here in a couple of years' time. So
is this going to happen in our lifetime? It's so crazy.
I think
this sounds like Space Odyssey or something. I mean,
yeah, this is emerging technology, right? I get to do this every day. It's a lot of fun. So yeah, I do think so. I do think it is going to happen in our lifetime, right, Eric? So SpaceX is we're estimating SpaceX is going to have about 44.5 billion in annual in revenue in 5 years' time, right? So that's up 394% from the 2023 revenue number. And that assumes kind of a 10% year-over-year rocket launch increase, which is very conservative, and only a conservative 4 million new SpaceX subscribers per year. Again, there's 2.5 billion people on the planet that don't have internet service. So I think that's going to happen pretty soon. So that puts the company at an $891 billion valuation by 2028. That's a 350% return in 5 years' time.
it's not
So
bad.
that's SpaceX in a couple minutes, right? On why I think it's an interesting opportunity.
That's fascinating. Like I knew everything until you got to space mining. Then I was like,
yeah, that was it.
And space manufacturing, I was like, I didn't know it was that. I didn't know it was like that. So before we talk about the index fund, or actually let's talk about the index fund. So, I think from time to time, like you just said, I did not realize it was that big. It would be number 39 in terms of company size. So you basically, and all private, right? Not, never been public. Give me, I know in general, like you were talking about a diversified portfolio, and the idea of adding this this segment of the market, you're adding effectively a large cap stock to your portfolio that's otherwise unavailable. So
That's right.
what I'd really like you to kind of talk through is there is a sense of, I want to talk about diversification in general and the need to obviously diversify, single stock risk versus multi-stock risk. But I also, and you have it on here, perfect. It's almost like I teed you up without knowing it. Like the where all of these companies are in terms of if you were to put it in as part of an overall diversified portfolio as a basket. So with that, I'll let you kind of talk through this index too.
Yeah, so these are primarily technology companies. They're all high growth companies. So this would kind of firmly fit into that large cap growth, allocation in someone's portfolio, right? To the point you made earlier, Eric, these numbers are as of June, right? But you can see the size of the companies here. This is their current valuations as of June. These are the call it pre-IPO stocks right here. These are the names and where they would rank in the S&P 500 as of June 2024. So these are big companies, right? You can also see the amount of revenue that they're generating as well. And they're not small. These aren't small companies either. And the names and where they would fit. And a lot of these names, people are familiar with these brands, right? As well. So these are really big companies. If they were public, they definitely would be the S&P 500. Right. So I think it's important to get exposure to these names, as I believe, several of these will be in the top 10, top 25. Right. There will be $1 trillion company in here that will be having an acronym for in 10 or 15 years time, like we have the Mag 7. Right. So that's coming. That's coming down the pipe for sure. But to talk about diversification. Yeah. So I've had a lot of folks ask me, we have an individual, we have 6 individual stock funds that we're offering right now because a lot of folks have really high conviction around specific names. So they like to build their own portfolio, right, Eric, of these individual companies around the names that they like. But then also we have some folks that just like to just invest into one fund that's got a diversified exposure. And that's what our index fund is here. So, so I have some thoughts here. Maybe I'll just run through those real quick if that's all right, Eric.
As long as
okay,
you
so
go for it. No.
So the top 10 index fund seeks to invest into the top 10 pre-IPO stocks by valuation. It's equally weighted portfolio. Okay. The fund does not rebalance or add or remove stocks. So we kind of buy these initial stocks and then let them run and play out. We buy 10 pre-IPO stocks and hold them to the respective stock as a liquidity event. So that's an IPO or an acquisition. And we gain the pre-IPO stock exposure in the secondary market, which we talked about earlier, right? The fund seeks to passively track the AG Dillion Pre-IPO Stock Vintage Index. So I called MSCI, S&P, Morningstar, several index companies, and I asked them to work with me to build out an index. They didn't have the capabilities to do it. So I kind of leveraged my time. You mentioned FTSE Russell earlier and London Stock Exchange. I leveraged my time there to build a proprietary index that is actually investable, right? So the AG Dillion Pre-IPO Stock Vintage Index is that. And the goal is to passively track that index in the fund, right? We have one vintage index per year for the last 20 years. So there's like a back test, if you will, on this investment strategy that you can have a look at, right? Oh, and these are the names. So maybe just to hit on these real quick. So these are the names in the portfolio. We talked about SpaceX, OpenAI, XAI, and Anthropic are AI large language models. So if you've heard of ChatGPT, that's OpenAI, right? Or if you use that, XAI, Anthropic, OpenAI, they're all direct competitors. Okay, so 3 allocations to the AI, what I call AI platform space. Stripe is an online payments solution. So if you've ever used your credit card or debit card to buy something online, more likely than not, you're using Stripe as the interface to actually process the credit card payment. Databricks is a database solution for primarily used for AI. So if you're a good example is if you're a law firm and you want to use an AI model, you need to organize your data before the AI model can come and train on it. And Databricks will has this solution called a data lake. So they can upload contracts, white papers, briefs, et cetera, into this database. It'll rationalize that for them and then allow the AI model to train on it. So that's very important for a lot of businesses. Canva's like graphic design for the everyday person. So you can make beautiful marketing campaigns, social media posts, etc. using Canva. Very great company out of Australia. Revolut's a big fintech out of the UK. They have a business here in the United States as well, but they're in fact, one of the largest banks. It's all online, all digital bank out of the UK and Europe. Epic Games is Fortnite video games. So if anyone has children or grandchildren that play video games, more likely than not, they've played Fortnite. That's Epic Games. They're out of Raleigh, North Carolina. Epic Games also has a technology called Unreal Engine, and that is for augmented and virtual reality, right? So any developer that wants to create an augmented reality or virtual reality solution is using Epic Games technology to make that happen. Kind of a good example is if you've ever looked at real estate and you've kind of like zoomed in to the house and you're in like a 3D environment walking through the house, that's Unreal Engine is the backbone of that technology, right? So imagine putting on like those new Apple headset, or there's conversations about having in the future, there's people working on contacts. If you put a contact in your eye and you'd have this like augmented reality overlay on the real world, that will be driven by Unreal Engine technology. So that's Epic Games. And then CoreWeave is like a cloud provider, but specifically for AI. So if we all started an AI company, like we had an AI application and we needed to run that and run that application on a cloud provider, CoreWeave is the perfect place to do that. They would compete with like AWS, Google Cloud, Microsoft Azure, but it's specifically designed for AI solutions. So they have specific solutions directly for those companies. It's a great business out of New Jersey. So those are the companies in the space. This is
Hold
the
on one quick
vintage
second.
index.
Hold on one quick second, because I think
go
there's something that I think it's really interesting on that list. So you know, in terms of opening up probably, like I would say that in terms of the highest growth area of the market, public or private, AI last year, 2023, I think was like the big winner. And I'm looking at this and I'm like, I don't know that there's really a public, to your point, not to go back to diversification, but really to bang the drum on it, to be able to access in one shot AI, and not just, you know, ChatGPT, but like other large language models, and then actual applications like Databricks, how companies are using them, all the different facets of AI. Is there anything like this for investors right now?
No. So, I mean, there's AI ETFs, right, Eric, to your point, but I was like, I built indexes and I ran an ETF company. So what will happen is they'll take Google and say, well, Google has an AI solution, so we'll put Google into the ETF. So that's not what I would say is, to your point, there's no pure play exposure, right, to the underlying kind of players within the AI ecosystem in the public markets, right?
Right.
So you could get AI exposure through Google, I guess, right? But you're also getting everything else that Google does, search, ad, everything else. That's not pure play exposure, right? That's a very diversified company, technology company. So this is where you're going to get pure play exposure to these emerging technologies that are coming, and specifically, AI. I think this is the right way to play that theme, that investment theme.
I like the other side of this too is, you know, and people can look into this, you know, after this call, but there's so many ways with these emerging technologies. You can sometimes have overlap, right? Like XAI, OpenAI, they're like direct competitors, but one of them will win. One of them will probably buy the other one, right? But we're kind of pre-consolidation, and you're able to, again, get that pure play, but have access to all the foundational pieces, similar to like crypto, right? A couple of years ago, you had a bunch of wallets and MetaMask and all these different, I'm not going to throw names out, but it all somewhat consolidated. The ability to have these companies that are growing rapidly, very pure, but have a couple that, in case one fails, you have the other one that'll probably take its place by taking its market share, and you win regardless, is a great way to play, you know, this particular, I call it a trend, but I think it's really more of like a revolution. Like it's almost like the steam engine, right?
Yeah.
Countries are fighting to have, you know, AI dominance, right?
That's right.
Whose AI is going to be the kind of the foundational, you know, bricks of AI, the learning models. And this is a great, it's kind of an agnostic way to play something. I think it's going to change the world. So really good job creating this.
Yeah, it's good. And also too, I got to tell you, Eric, I think it's interesting because if you look back through history in America, small companies tend to become very big companies, right? In the span of a couple decades. So, if you go back to 2008, before so the iPhone was launched in 2008, right? If you look at the S&P 500 in 2008, ExxonMobil was the number one stock in the S&P 500, right? So it kind of gives you a sense in just 15 years time, how different things have been. And if you go and look at the companies that are in like the top 25, top 50 of the S&P, there's a lot of companies that didn't exist 20 years ago, 30 years ago. They didn't exist. They were brand new startup companies. So I believe out of this group of 10 stocks, right, and several other pre-IPO stocks, it seems hard to imagine that they could become trillion-dollar, multi-trillion-dollar businesses and be in the top 10. Like, why would someone not buy them? But these guys are growing so fast. They have access to so much capital. They have such large customer base and such brand recognition already. They're gonna make their own charge forward with their own path. So yeah, I mean, this is a really, I think, interesting opportunity to get in to these companies. And I do think you're right. I think, having kind of a diversified approach to this asset class is very smart.
Yeah.
Cool. So, okay, let me just hit on the performance real quick. So again, this is the index performance. So take that for what it is. This isn't live money. It's an index. So TVPI, these are all kind of fancy venture capital terms, but the core of it is this is a 436% return, right? So on average, looking at the vintages that are 15 years or 5 years and older. So if you put in, let's say, $100,000 into every single one of these vintages, your average return would be 436%, right? And of that 436%, you would have gotten 231% back, realized cash in your pocket, right? That's like a dividend would have been distributed to you as a dividend, right? So that's the metrics. Kind of the target return for venture capital is like 2 to 3x your money. 3x is the sweet spot, right? So at 436%, that's a great result. As discussed, these are late stage venture backed companies, and they have a very different risk profile than I think traditional venture capital, where it's like two kids in a garage, right? Companies like that. So these are big companies with a huge customer base, with a lot of revenue. It's a much different risk adjusted return profile. But what I would offer too is here's a couple portfolios just to like hone in a few years. You do get access to the power law, which is the secret sauce in venture capital investing, right? So the idea in venture capital investing is you have a diversified approach, like you mentioned, Eric, into companies, and then one or two of the companies really go and take off, right? So you can see here in 2011 is a perfect example, right? So you have a portfolio of 10 names. Some of them went public, Palantir, right? 2,700% return. Some went bankrupt, which is not uncommon in venture investing. Others just absolutely took off, right? Rocket ship, no pun intended with SpaceX, right? 18,000% return. So that's what you want. You're looking for this type of a solution here, where you're at. The thing that I'd perhaps pat myself on the back with is this index was built with like institutional rigor. So there's no funny business. I didn't go back and massage the index methodology to get good results. We got the losers in here, right? Like a Theranos that's screened in. It's a rules-based methodology, right? You also got the winners. So as you look at this return profile, this is what would have happened if you were sitting, on January 1st, 2012, and you invested. These are the returns that you would have gotten, right? If you would have gone through that process. So, the worst year that we've had was down 38%. The best year was 2011, even with a couple zeros in there, right? 2,218% return. The median return was 265. And then in 2008, the global financial crisis, again, you kind of see that power law show up with Meta with an 8,000% return, right? So that was a year where everything did really poorly, but you had one company hit. That's all it took to deliver a pretty great return, 767%, right? So that's kind of a core component of it. Lastly, I'll probably just hit on a little bit of the trading side, right, Eric? So this is like blocking and tackling on how we actually get exposure. So we have 50 institutional broker relationships in the pre-IPO stock market, which took considerable time, effort, and money to kind of develop those relationships. But with those 50, we get incredible price discovery. So when we go to market, we request offers from the 50. Offers come back. On average, we get 16 offers per trade. That's great price discovery in a very illiquid and non-transparent market. The spread between those 15 offers or 16 offers is 15.8%. So that's the lowest offer in price to the highest offer in price, 15.8%. If you were to go into Schwab right now or Fidelity and buy Apple stock, like market order, you maybe get a 1 penny spread, right? Nope, that would be it. This is 15.8%. So you will get your face ripped off if you don't know what you're doing, right? When you do a trade here. And then the average where we close a trade is 4.5% price improvement versus the median. And then what a lot of people like to say is like, well, what was the last round at, Aaron? Right. So the last primary investment round that was on Bloomberg, for company X said that they raised, $3 billion at a $50 billion valuation. Like, what price did you get? And on average, we're 6.5% premium to that last round, right? Which is great, great inclusion, a great execution. So
Can I
that's
be a little
that's
nerdy?
the last piece I see there.
I want to ask a nerdy question that I think is important for people to know. So when you buy these things, just talk a little bit about how sometimes these things can be packaged with additional fees inside. Like you could be buying another SPV because I think it's super important. If you buy Apple and it's $100 and then you sell it for 110, you've made 10%, right? It's very simple. There's no kind of hidden, things in there. Can you talk about how in the secondary market, it's not that simple and how your diligence kind of avoids landmines of hidden fees?
Yeah, sure. Yeah, absolutely. So there's two types here. Let me kill this so we can talk bigger pictures here. I'd say there's two primary ways to buy in the pre-IPO stock market, right? There's more, but I would wax on about two or three others on why you wouldn't even want to touch those with a 10-foot pole, right? But there's two primary ways that you'd want to get exposure in the space. One is you buy the company stock directly on the cap table, right? Which feels more like what you just described in the public markets, right? You buy Apple stock, you're now on the ledger and own Apple stock directly with the company. It's the same thing, in private company stocks. You can buy a stock from an existing employee, existing shareholder directly from the company if they're issuing new shares, and you're on the cap table, right, for that business. Increasingly, what's happened, and this has been a big trend in the last like 2 or 3 years, is you buy through what's called special purpose vehicles or SPVs, right? And those look and smell very similar to like an ADR. So I don't know if everyone's familiar with ADRs, but that's an American depository receipt. So if you want to buy Volkswagen stock, Volkswagen trades on the German stock exchange, right? So if have a Schwab account or Fidelity account, you can't buy stock on a German stock exchange. It's in euros. It trades in euros. It's a different country, right? All of that. It's not trading on the New York Stock Exchange or NASDAQ Stock Exchange. So Bank of New York Mellon issues an ADR. So the ADR is listed on the exchanges. People invest their money into that ADR. Bank of New York Mellon takes everyone's money. They open one brokerage account in Germany, and then they buy Volkswagen stock. So the ADR is effectively a pass through. The only thing it owns is Volkswagen stock. It's a pass through investment into the company. So SPVs or special purpose vehicles in the private stock market are the exact same thing. So if you're if you're a venture capital firm and you bought OpenAI stock at a $5 billion valuation and now it's 150, and you had, let's say 25 million, I'm making these numbers up, $25 million investment, and now that 25 million is worth 900 million, right? Might have some of your investors say, hey man, I want to get liquid on this. I want to realize some of this gain. So the venture capital firms take their OpenAI stock out of the primary fund and move it into its own legal entity. And that's the special purpose vehicle. The only thing that's in that legal entity is OpenAI stock, right? And then the investors can sell their interest in that legal entity to other people. And guys like me come in and buy those, right? So that's effectively how the secondary market works.
Can you talk a little bit about, though, I think what's important is that each one, like an ADR is going to have a structure that has minimal fees. These SPVs can have, structures of their own that have, like, you just talk about some of the management fees and carries and what that sounds like. Cause I think from and I really want to impress upon people, like, the benefit to having somebody like you actually go out to 50 different, you know, brokers and say, I want to buy this, get 16 bids back. And then you don't just look at like the price. It's not like they're just saying like 40 billion, 42 billion. Like there's those finer points that, can you talk just about that a little bit?
Yeah, so those SPV vehicles could have a one-time upfront fee. They could have annual management fees. They could have carried interest themselves, right, where they take a percentage of the gain. They could also sell to you at a premium to where the market's currently trading today. So there's a number of things that potentially could happen within that vehicle. Also, too, it's a venture capital firm. So it's not Bank of New York Mellon with the ADR. I think you can feel pretty comfortable. Bank of New York Mellon's going to do a nice job managing the ADR. So there's also this element of due diligence on who the counterparty is and making sure that that's a good actor. They're filing their docs with the SEC properly. They're getting audits on the fund and et cetera, et cetera, et cetera. So there's like some due diligence that's required just on the counterparty itself, in addition to understanding the fee structures of that SPV. But that's part of the price discovery, right, Eric? So I think, as to your point, like those 16 offers come in, sorting those offers from top, like kind of best to worst, is a little bit art and science, right? Because I think you have to really get in and understand exactly what they're asking or what they're quoting to you. Of course, the quotes never come in a structured way. So every quote comes in different. You have to like kind of dissect that and understand it. And then, you kind of rank those top to bottom. There's also a lot of discussion. Like I just worked with one of the industry pricing providers called ApeView to create an SPV calculator, because everybody would keep coming to me and telling me what their fees were and say, oh no, that's equivalent to this price. And I'm like, that is 25% below the number that I got. Right. So there's even some differentiation within the market about, well, how do you translate a 20% carry in an SPV to, as what they call 0-0, so a no fee SPV, or just direct to cap table trade. So like those are the nuances that you got to get your head around. It can get very expensive. So I've seen offers for some companies where they're offering the SPV at the last primary round, what price, right? And then the same offer kind of packaged back from another broker, they're offering the last primary round with 20% one-time upfront fee and a 20% carry, right? And then sometimes what they'll try to get you is they'll do 20% upfront one time, 20% carry, but instead of offering the stock at $100 per share, which is where the last round was, they'll offer it at $75 per share, right? So now you have to do some math to like understand where that actually equivalency point is. So the complexities there. I think that's why it's important to have a good partner. But I can't stress enough how important the due diligence is, because you can talk about the price that you get, and maybe this price is better than that price, but you really need to make sure whoever you put your money with, right, is a good actor, right? And they're going to do what they say they're going to do, and the fund's going to run properly. And when time comes to hopefully, have a liquidity event, everything goes smoothly. The taxes get paid proper. If there's any kind of tax issues, or not tax issues, but taxes need to get paid, everything gets done, taxes get paid. Everything just needs to be perfect from a fund structure and a due diligence structure. So that stuff I take very seriously, right? In fact, that's the most important thing for me, is to make sure that, I won't accept an offer as real unless it's a good counterparty. Right.
Right.
And so we rank those offers kind of best to worst on the criteria that I mentioned. And then we dive in and do due diligence on that best offer that we like. And if we don't like what we see, we move on to the next one. Right. So I've had situations where I've taken an offer that was like 1 or 2%, not as good as the primary offer that we received, because I wasn't comfortable with the underlying manager of the fund. Right. So I think it's important to make sure there's that too. Plus, there's just also rules, Eric. I mean, the SEC has rules and regulations around funds, investing into funds. So you got to make sure you're following those too, which could have tax issues, as I mentioned earlier, if you do that incorrectly. So it's important, I think, to have a good partner. you know,
I
it's
think
important
that's
to have a good
exactly
partner so you
why
know
I
what you're
work with
doing.
you. Cause I mean, this
Yeah.
is a world, and I think anybody that listens, you know, to this will, I mean, hopefully will pick up on your expertise, but pick up on your diligence. And I will say you are one of probably like the 4 people I know that will read every document that you get from beginning to end.
Yeah. It's, I know I think it's a hangover from my time at Morgan and TD. I was the guy at Morgan and TD that would review mutual funds and ETFs and decide if we were going to put them on the platform or not. Right. So all of the things that we're talking about are things that I did at Morgan Stanley and TD Ameritrade. Right now, of course, I'm just doing it for my own business and the investors that work with me. So, um, yeah, I'm a little old school, perhaps. I like to cross T's and dot I's. I'm a stickler for
Good.
details, right? But
Yeah.
but I think it pays off, hopefully, for the investors in the long run.
Excellent. So we're gonna button this up. I want you to tell me when when these funds close, when the
Yep,
next ones that are coming after this are gonna
sure.
come, and
Yep.
just so people have an idea of time frame. And
Yeah.
then I'll
Okay.
just plug myself and say if you're interested, we're happy to process everything on our side to make it like super easy. You know, and candidly,
Yeah.
we work directly with Aaron to make all this happen. But I
Yep.
want you to give us, you know, kind of time frame for all of what we're going to do.
Yeah, so first of all, I only work with financial advisors, right? So if you'd like to invest in the funds, Eric's the place to go. And then, but yeah, we have 2 cycles every year. So we offer a set of funds like now. So we're closing up this current set here in early October. So we have like a September, October offering every year. We also have like a February, March offering every year. So it's basically every 6 months is the two sets of offerings. And then for this cycle here that we got today, this one or this cycle, I should say, this month is we have the index fund, which we talked about, SpaceX, and then I'm sorry, we have the index fund, which is the diversified fund, 10 stocks and one portfolio. And then we have 6 individual stock funds. So one fund, one stock, right? So if you wanted to build your own portfolio, you could build those as well. The minimums for the individual stock funds are $2,500. So it's very low. I wanted to do zero. The lawyers wouldn't let me do zero. So $2,500. And that's SpaceX, OpenAI, well, I should say SpaceX. So for space economy, SpaceX, right? For what I call AI platforms, we have OpenAI and XAI. So XAI is Elon Musk's large language model business. We talked about it earlier on the in the index fund, and then we have 3 picks and shovels, AI picks and shovels play. So Grok, which is a chip company, Databricks, which we talked about earlier, and Hugging Face, which is a community. That's an
You got
interesting
a
name for a
better
company,
name than
but
that, man.
great. It's a great bit out of Brooklyn, right? But great company focused on AI software developers is their kind of bailiwick. But the Grok is a name I'm particularly interested in. We haven't talked about those two, but NVIDIA is hot right now. A lot of folks know about NVIDIA. And just to drive home kind of some technical points on that, NVIDIA makes chips called GPUs, graphic processing units, and the GPUs are made to train AI models. So to your point, Eric, like everybody's been talking about AI, NVIDIA has been a big beneficiary of that. It's because of these GPU models, these graphic processing unit models. So GPUs can be used to train AI models and also run them. So running an AI model, the technical term is called inference, right? And really NVIDIA is the only game in town to train these AI models. Grok makes chips specifically designed to run AI models, right? So as all of these businesses start to implement AI and build their own AI models, and now they want to run them, they're going to need solutions and access to chips to run these AI models. Grok's models are significantly, or excuse me, Grok's chips are significantly less expensive to run, and they perform about 10x better, right? Jonathan Ross is the CEO of the company. He started and ran the chip business at Google. So Google has these things called TPUs, tensor processing units. That's their NVIDIA, kind of their proprietary chip within Google that offsets like NVIDIA's GPUs. So Jonathan Ross basically did it, started a business within Google, scaled it, and decided, you know what, I'm going to do this myself, and started Grok, right? So Grok's chips are LPUs, language processing units, and they currently have a $3 billion valuation in the market. I think this company has a lot of room to run, right? So NVIDIA's got a $2.5 trillion market cap. Grok's at 3 trillion or 3 billion. I think this company could be a big one. So big fan of Grok, but look, 6 individual stock, kind of individual company funds, and then a diversified fund for this cycle.
That's awesome. That's actually, it's a great flyover for the extra ones too.
Thank you.
I'm gonna button it up there and just say, you know, we've got a couple weeks here to kind of get any interest in. I'll send this out, so if you're watching it via recording, you know what your time frame is. We can take care of whatever you need to have done. We do have one other live participant. Tim, is there any question? You logged in?
Yeah.
Anything you'd like to ask?
You talking to me, Tim? Tim Head?
Yes, sir.
Oh no, I was good. Aaron, what's to flush these stocks out of the pre-IPO market? Could they hang there? I know maybe SpaceX can hang there for a long time, forever. I mean, in theory, I guess.
Yeah, so there's a lot of capital in this private market now, Tim. So you're not wrong about that, and they can hang in there and stay. I do think there's some benefits to being public, right? Obviously, there is a lot more access to capital in the public markets than there is in the private market. So to the extent that folks think that they need more capital than that's available to them, or perhaps more capital that's available to them at the right valuation, right? They might want to go public. The second point, I think, is it's the unlock. I think the valuation unlock. So
Yeah.
if you imagine the investors that participate in the private market, everybody's an institution, right? I don't overpay for stuff, full stop, right? So, but you get into the retail market and things can take off, right? Because there's a lot more buyers in the market. So there's some inherent benefit, I think, of being in the public markets. Also, too, when the very big institutions want to get out and they have massive position sizes in the billions of dollars, there's really only one way to do that properly, and that's in the public markets, right? So I think at some point these companies got to go, and I think they will. So I think it's just a function of time. We need one or two of them to go. I think it's going to open up. It's going to break the dam, frankly, and we'll probably get back into a more natural cycle with the rates coming down. Frankly,
Yes.
I think that's going to help. That'll help a little bit too. Yeah.
All right, that makes sense. Thank you.
Thank you.
Good deal. Well, I feel like so, and I'll give you a plug as we go here, Aaron. Like every week, Aaron does an awesome. It's like 2 to 5 minutes every week overview on the IPO market, pre-IPO market. Usually gets into a couple of these specific names, talks numbers, goes through it really fast. Actually puts the words up on the side so you can read it while he talks. It's like subtitles right next to his head, which is great. I've started doing that with my kids. I like subtitle everything. And so they learn to read, and then now I read instead of watching shows. So he's got both, but it's a really good update. And I think that's what I really kind of want to plug. So if anybody wants to get involved, or I shouldn't say involved, but wants to get added to that list, let me know. And I'm happy to, pass on that as well. Cause if you want to stay abreast of what's going on, I mean, like to your point, Aaron, like I just SpaceX in, the last 6 months watching, and I know you don't talk about it every week, but when you bring things up, or like ChatGPT, OpenAI, these are not like little things. I mean, you're talking these language models can do, I mean, people probably already know this, but I mean, you could put in a couple words and it's going to create a movie. It was putting a couple words in 9 months ago, maybe not that long ago, 6 months ago, and it was making images. Then it was like creating movies. I mean, there's so many more things it does, and you cover a lot of that on these Saturday calls. So if people want to hear kind of what's going on, it sounds a little far out, but it's right around the corner. I think,
for
there's
sure.
interest, let me know.
Well, look, that's the thought earlier, Eric. Sorry, not to wax on about this, but that 2015, the iPhone came out, and I think if everyone looked at each other in 2008, 2008, the iPhone came out. If everyone looked at each other in 2008 and said, "This is what the world would look like in 2024," we'd probably laugh at them, right? So I think you fast forward 15 years from now, the world's going to look like a very different place than it does today, and there's an immense amount of investment opportunity there. So look around the corner. That's what the research is all about, right? Just looking around the corner before
Mhm.
everybody else can, so you can kind of spot some of these opportunities to take advantage.
That's a great mic drop moment. I'm
Right.
gonna, this is what we should have started with. I'm gonna take that snapshot. I'm gonna put that at the beginning of the email I send out to everybody.
Perfect. Perfect. Thank you.
Awesome. Thank you very much, man, for being on. Really appreciate you.
Yes, thanks, Aaron.
Thank you. Thank you guys.
Absolutely.
Thanks, Tim. Nice to
All
meet
right.
you. All right. Cheers.
Bye.
The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.